everyone. My name's Stephanie Weber. Welcome to the Show Me How podcast.
And I'm John Skuris.
And we are so excited today about our topic.
Yes, we're here to talk to you about real estate. As you know, we cover commercial real estate and residential real estate. And today, Stephanie's pulled together a great episode for us.
About mortgages. That's exciting. But we've been away for a couple weeks. And John, what have you been up to?
Oh, traveling here and there, getting my passport renewed down in Miami with all the wonderful people down there.
Okay.
Driving through construction, riding motorcycles on the A1A, taking a yacht across to Bimini that started taking on water.
Yeah, my brother told me about that. That was interesting.
What else? Went to Key West, golfing, fishing, caught 6 mahi. I think they're mahi-mahi, and 1 blackfin tuna, which we had prepared by a chef, which was amazing.
Nice.
And other sorted activities.
Of course. We won't go on your sorted activities. We'll leave those alone.
Spend time with your brother.
Yeah, he's always...
The famous Dean Stanley, everybody.
Right, and he is a sorted activity.
He is a sorted activity. He's under that sorted column, for sure.
Yeah, like what's going on there. And I went to Italy.
Yes, that's right.
Yeah, I was there during the conclave.
I saw some of your pictures. They look like a great family outing. You had all the kids with you?
All the kids. We went to the conclave and...
We had Captain Caleb's daughter with us at some of the bars, just 7-year-old. That was good.
That's one of the sorted activities that we're going to leave alone. But yeah, it was great in Italy. I'm glad you had fun with my brother. And we could...
And his roommate, Mike. Wonderful time. It was a good time. I think you had some good words for Mike.
I didn't say a word. But back to the episode. We're back. John got back safe and sound. I got back
to Chicago's clouds and rain and cold. It's like 50. I'm sunburnt. I was burnt multiple times. Basically in Florida, I just burn continually. So,
you don't get golden brown like my brother?
Well, after burning 3 or 4 times, I finally get golden brown. It took a couple burns.
I don't know if that's a good...
Well, how do I look now?
I don't know if it's a good strategy in the skin cancer department, but we'll let that go. Don't take John's sunning advice. But, my brother's my brother. But when we're talking about mortgages, we have to, I think you and I talked about, just add some humor to it because it's a daunting...
Yeah. Well, that's our whole thing, right? We want to talk about real estate, but we want to make it funny, too.
Yeah, because
we're not like the valedictorians of finance and real estate or anything like that.
No.
We're here to bring you the topics that we know. We learn, frankly, as we're going on here, just as you are in some cases.
Right.
But we want to bring it to you in a useful manner and make it fun and enjoyable to listen to and learn about. And
I think with this topic, the buzz about the 1% conventional mortgage that's out there now, because as you can see, the real estate market's crazy. People are paying $20,000, $30,000, $40,000 over asking.
Yeah. And,
when you're looking at that, come up with 3%, that's 3 to 5% is a little daunting. So,
well, is this a new product that's out in the marketplace? That's why we're talking about it, right?
You're right.
Yeah, so
it's something that just popped up. It's something that is everyone's talking about. But what actually is 1% down? What does that mean?
Well, that's what we're going to go into today, right? We're going to go through details. I was just curious, where did this thing come from? It's just a new thing out there to get the market stimulated, it sounds like. Exactly.
Because, like I said, when people are paying $500,000, $600,000, $700,000 for a house, to come up with 3 to 5% is not always easy. But is the 1% something that, we want to... That's what we're going to talk about today.
And so basically the target audience for something like this, a first-time home buyer, renters who are ready to buy, young professionals like our children, Brett and Riley, and newlyweds, I suppose, fits in that category too.
Right.
Yeah.
Right. So they're going to look at a lot of different things. But again,
we're going to break down how it works, who qualifies, and what to watch out for.
Exactly.
And how it compares to other loan types, right?
Right. And then we're going to look at a real case scenario of someone that actually use this program.
Okay. A scenario.
Scenario. Yeah. Using this program, I should say.
It's too new to actually have any real empirical evidence right now.
So,
so let's get into it. So
yeah, let's get into it.
Let's take it away. So the 1% mortgage, is it a good product, or is it something that the bankers are just trying to make money off us on? That's kind of the thought I had out of the gate. Are they just using this as a hook so the bankers can make more money and drive their Ferraris, or is this a real product? I think the answer is it could be both, right?
Right. I think this is where we're talking about, like, you really have to do your homework and understand what you're putting your name on and what you're signing off on. So we want to look at the 1%, what it actually is, compare it to the other loans out there. Like I said, look at a case study of a buying scenario using this, and then just how you look and shop for a mortgage in a smart way. So
it could save you thousands, or it could keep you from committing to a property that's going to end up costing a fortune. Is that right?
Right. And turn into a money pit.
You don't want any money pits. You're going to, 1% sounds like a great deal, but, you got to look at the product strategically and kind of look at it from all the different points. What product of loan are you going to get into? Because 1% sounds like really exciting. Right? I only need 1% down, but you're going to pay for it other ways.
Exactly.
Now that may be fine because especially for students, I think coming out of the gate, you could benefit by jumping on a product like this by getting into the 1%. We'll tell you about a whole bunch of other things that are coming along with it, but you get into this property and then it increases in value, right? Just pure inflation and
exactly
increased valuation. And then you refinance it in a couple of years under a more conventional product where you can drop some of the ancillary charges off, right?
Exactly.
Okay.
So I'll let you go over the mortgage math moment for us.
Yeah, so I guess a great example, and this kind of reminds me of the case study a little bit. Buying a $300,000 home with 1% down means basically you have a $3,000 upfront payment, right?
Which is...
it should be not much if you're looking to buy a home, right?
Right.
That's incredible. But let's be realistic. In Chicago, that's $500,000, or you know what I heard when I was in Florida? A 2-bedroom condo is $750,000.
Yes.
So that's insane. It isn't even a multifamily.
That's not even including your HOH.
Right. It's $7,500 in that scenario. But, the PMI and the higher rate of your monthly payment could make it $400, $600 more, right? Depends on your calculations, which, that's $24,000 to $36,000 over 5 years. So you got to make it worth your while. So we're going to help break that down for you to help you figure out what that's going to look like and is this the right product for you?
Right. And then look at would you rather put 1% down with PMI and higher interest rates, or 3.5% down with lower interest rates but more upfront costs? I think it all looks at the scenario you and I were talking about with, our kids at that age. You don't want to be stuck in a, house poor, or then also you don't want to be stuck in renting at 8% inflation.
Right.
So,
which is what we just went through.
Right.
People's rents were going through the roof here in Chicago. I'm sure everywhere. And, rents have gone up dramatically. I mean, there's apartment buildings downtown now that are $4.50 a square foot a month. So $4,500 a month for 1,000 square feet.
yeah.
So, that's if you're renting and you're stuck in that moment, and there are a lot of people I saw get hit with that. And I'm a landlord, and I've been trying to hold off on passing the costs up to my tenants, but it's been 2 years and I got shellacked and my taxes have increased.
Yeah.
So I have to pass on, pretty significant bump to my tenants this year.
Yeah, and that's a tough scenario. You don't want to do it, but...
I love them. They're great people, and they've been there for over 10 years, dream tenants, but I can't afford, paying this huge amount. So
exactly.
Anyway, this is what is going to come, could they have done this? They were stuck, actually. They were trying to buy a home, but when the inflation hit and the interest rates rose so much about 2 years ago, they couldn't do it because it just hit too hard.
It was too hard. So
now they're stuck in this situation, exactly what we're talking about.
Right.
I'm going to have to raise the rent $200 a month or something. 10%.
And then they have nowhere to go.
I don't know. Now that this product is out there, maybe they do.
Yeah.
Maybe I shouldn't be talking about this.
So, that John's tenants, please don't tune in.
Yes.
So when we talk about mortgage myths of the week, do you always need 20% down while we're talking about that?
No, it depends on the product type, but it also depends on the financial market.
Right.
So, in commercial real estate, typically you need 25% or 30%. But today it's even worse. So because of the CMBS market, commercial-backed securities market, there are lenders that want 40 and 50% down. And you have to have an active income. So if you don't have an income, but you have the money, they're still like, no, thank you. This value is not what you think it's going to be, because a vacancy should value at about half of what it would be worth when it's renting and fully occupied. So, at 50%, you put down 50%, the bank's breaking even if they have to take the property back. Maybe, right? So anyway, no, you don't have to have 20% down. You could have less. And again, it depends on the type of structure you're looking at. Now, I will tell you competitively, when you're going for a piece of property, that often can indicate a competitive advantage for you if you're bidding on a home. Right. Again, I work in commercial. It's a little bit different, but in residential, that's a big thing, right?
It's a big thing right now. A lot of it is actually cash buying. People are...
exactly, because it gives them an advantage.
Right. Gives them an advantage. But, what we want to do is just put it out there, everything, to give you an idea, that you can get a mortgage if you have 1%, and how we can help you do that. Or maybe it doesn't make sense. Maybe you rent for a couple more years and you save the money. But
and by the way, working with smart, well tuned in brokers or consultants like I am for financing and the financial market can also help you, because I was just talking to this customer who wants to list his property for an unrealistic amount. It's like $8 million, but the valuation's coming in at more closer to 6 or 5.5. And I said to him, I go, look, there's two ways to look at it. One, you just wait, right, until the rates change and everything adjusts, but that's uncertain. I said, the other thing is you got to look at what are you going to get now? So if we get you 5.5, and you wanted 7.5, which might take 5-7 years for you to get to. Right. Is the better thing to sell it at 5.5 and put it in the market and make a bunch of money there, or make some other alternative investments? So the opportunity cost of those funds is a real thing you have to consider too. So
exactly.
And this is the same with this 1% loan, exactly the thing we're talking about. So again, there's benefits to it, but you're going to pay in some regard. So and we're getting into that now. Exactly.
Well, I know we've been talking a lot about things, and I just want to make sure our listeners understand all the different acronyms that we have, right?
Yeah, well, and let me just introduce this segment. So we're calling it, for this episode, Lender Lingo, but I don't think we're going to keep that name. We want to provide you with education on these acronyms, because it does get complicated, even for us, right? Mm-hmm. So in this case, we're going to try and preface these segments with some acronyms that are relevant to this topic that we're going to discuss for you in this episode.
So am I quizzing you?
So let us know. Yeah, you could do that.
Okay, quiz John.
Let us know if you find this useful, please.
Okay, this is a lightning rod.
I'm going to cheat a little
bit. For
right,
50 cents, do you know this? What is PMI?
I just knew it a minute ago. Pre-mortgage insurance. Is it? No, private mortgage insurance. Oh, my God. I don't know it. Remember, I'm commercial. We don't have those things.
What is it for?
It's to insure I know what it's for. That's goodness. Insure the lender in the event that you default on your loan.
Right. So it's not for you.
It's like an insurance policy. Yeah, it's not for you, but you pay for it.
Right.
All right.
What's MIP? John, you're failing at your own lightning rod.
Mortgage insurance premium. No, I don't know these things. I'm not.
I know. That's why it's fun to throw them at you because you don't know them.
Mortgage insurance premium, which I don't even know really what it is.
It's the FHA's version of PMI.
Oh, okay. So it's for federal housing loans.
Yeah.
Okay.
What is APR?
Average percentage rate. Annual percentage rate.
And what does it include?
What does it include?
What is included in that?
Well, it's not your interest rate per se. It's the amount you pay overall for the loan. So if it's like 8% interest rate, if you look at the APR, it's like 8.13.
So it's your interest and fees.
Exactly.
We'll give you an easy one. You can even get this one. What does HUD stand for?
Housing and Urban Development.
Oh, look at that. Ding,
Yes.
ding, ding, ding. What is a buy down?
When you buy points, you can pay a certain amount of money up front to buy down your interest rate, your APR.
Very good. And what are those called?
Discount points.
Look at John's getting a better score. He's at 50% right now.
It's federal.
So, you
commercial.
can buy this interest rates and reduce your long-term mortgage,
Yes.
which is great. So
I feel like my son, he just went through his finals.
Yeah.
He was stressing out. He had to apparently look at some other person's paper during the test.
He had to borrow some answers.
I'm not going to say which son this is.
He was borrowing answers.
He's like you, looking over.
Looking at the paper.
He said just one.
Sometimes you have to borrow answers. So to give you like a visual, if you feel your lender says it's only PMI, but it's $312 a month.
Right.
They always say it's only. If anyone's saying it's only, that's relative term, I think.
Yeah. No, here, let me say something about this because it bothers me. This is the whole reason why we started this podcast, by the way, because I've dealt with brokers out everywhere, and there's wolves in sheep's clothing everywhere. These people are like, "Oh, we're going to sell your house for the biggest amount," and they start telling you, "Oh, you should drop it 20,000," or you're in a negotiation, drop it 15. You should just take the 15. If you look at how much they get compensated, it means nothing to them to drop it 15,000, right? And I'll connect it back here in a second. But to you, it's $15,000, right?
Yes.
Minus their fee, so they end up they lost $600, but you're losing $14,400. So you got to be careful with the brokers you work with, but also the financial brokers. So the bankers, everyone's like, "Oh, I don't know if I could get a loan." You can get a loan. Do you know why? Bankers are salespeople. They make money off selling their money. And it's basically free money because they've, fractionalized the whole financial industry. So when you deposit $1,000 into a bank, they get 100,000. I think it's something to that effect.
Right.
Maybe 10,000, 10 to 1. And so they can loan 10 times your 1,000 to somebody else. They're in the business of lending and using that money. So remember that. So look at them side-eyed. Side-eye view, and look scrupulously at what they're doing and try and make sure that you understand all the complexities of these loans because they're trying to make money.
Well, yeah, and I think it's just, that goes back to your broker, right? That can lead you in the right direction of a great lender because, you should be, as a broker, residential and commercial, you should be working with lenders so that you can make this process so much seamless for your client.
Yeah, I mean, ideally. But again, that's an advanced
and then
topic.
you kind of help them then, as we go into as we talk further about how do you get the right loan, as a broker, you shouldn't be like, "I don't know about loans." You should be educated on loans too.
Yeah, I mean, it's a slippery slope because, you don't want to be misinterpreted that you're an expert on it. However,
no, not at all, but you should know about them.
But you should know some general information, but more importantly, have somebody to refer them to.
Right.
So that you trust, that you've had experience with preferably,
right,
and that is going to give your customers a good information and good opportunities to get the best financing they can for whatever they're going for. And
we're going to provide this checklist on our website, but do you want to run through the checklist really quick?
Well, yeah, sure. So you want to ask about the interest rates, both with and without the 2% grant. So we're talking about this 1% down payment program right now, right? So it's really 3% down, but 2% of it is a grant. And a grant means basically that it's being gifted to you by the mortgage company. But in exchange for that, you pay higher rates and other fees could come into play.
Right.
So you want to ask if you're going to go into any type of mortgage, but in this case, we're talking about the 1% down. What's that 2% grant look like? What does the interest rate look like with or without that 2% grant? Right?
Right.
And then you want to know how and when and or if PMI drops from this loan ever, because in some cases, you have to keep PMI.
If FHA ones, you have to keep it.
Yeah. So again, not great, but you have to balance everything out and see, if it's going to get you in a home, that's important, right? So you got to decide if that makes sense or not. You have to understand the difference between APR and the interest rate, so you want to make sure you know that information. Compare not just the monthly fee, but look at your 5 to 10 year costs. It's just sort of like a credit card, right? Look it out. How much is this going to be costing me over those terms? And then look at the rental options that you have and see, am I better off? Now you'll have equity at the end of those 5 or 10 years, right?
Exactly.
So it's not a flat calculation. You have to think of it a little more complicated than, just what's the 5-10 year versus the rental, because you have equity to consider as well and tax benefits. So, but you should look at all those things. Ask about the refinancing flexibility, because that's important, right? Some loans have early pay down penalties.
Right.
Right. And this could be one of them. You want to find that out because you don't want to be locked in this loan forever. You're paying upfront fees, you're paying PMI, you're paying other things. If they drag out, it's going to cost you a lot of money.
Exactly.
So you want to be in a position to shift out and refinance, especially because your property is going to escalate in value theoretically, right? And typically, you're going to have an increase in valuation.
Exactly.
And so if that's an option after 3 years, like I live in a neighborhood called Logan Square in Avondale, and the property values have soared there, probably 6-8% a year for the past 5 years, something incredible like that. It might be a little high, but nonetheless, just insane. I mean, I bought my house in '98 for $305,000. It's easily worth 1.4. So, can you get out of that loan and get into something because of the valuation increase that's more realistic, more of a conventional loan or something like that? You want to be able to do that if you are in a booming neighborhood, especially.
Right. Totally agree.
And then you want to compare direct loans and versus mortgage brokers. I do some finance brokerage, business brokerage, and so I'm working with some people getting private equity money to come lend people for businesses typically. And, those interest rates are higher, but they're easier to get loans, and they have points on top of them. So you may pay 2.5, 3.5 points as a fee for some of these things. So on $100,000, you're paying, $3,500, and $1 million, you're paying $35,000 for 3.5. And that's a fee to me, partially. I get a fee. Then all these other brokers involved get fees. Right. Because we're helping facilitate this financing. But it's much easier to get a loan on the property than it is going through.
So then you have to look at your cost and benefits and all that
exactly.
stuff.
Is it easy? Do I qualify for traditional? Do I want to go a different route?
And then what if you qualify for multiple loan types, which is you look at, the lowest cost for you over 5 years to include PMI and closing
I'd use
costs.
5 years.
Yeah.
I think 5 years is a good.
I think so too.
You have to look at your individual circumstances, right? If you think 3 years you're going to be making a big change, look at it 3 years.
Right.
You think 10 because you have a child coming, you want to stay in the school district or something, and look at 10.
Right. And you can always pay more on your principal and pay down that add to you.
Yeah, that's a good point. If you're in a loan, you don't, or it's not a good environment within which to refinance,
right?
Then you could just add to the monthly payment. I do that
Right.
always. I always recommend that you do that because it goes down much faster than you realize. But not everybody's always in a situation to do that. Also, you have to look at the alternatives. What's the opportunity cost of doing that versus investing in the stock market?
Right.
Things like that are some considerations you should.
Well, sometimes you
think
get like a bonus or something you could throw at that, instead,
about. You get a big bonus at the end of the year.
Something.
Or a big sale, like in commercial real estate. You
Yeah.
get a big deal closing. You can throw down $50,000 to buy down your loan a little bit.
So when you're looking at the 1% mortgage rate, really, basically, is what we want to break it down versus myths versus reality and what the mechanics really are. Let's run through the definition of what is included in this. You mentioned grants.
Yeah, grants are a non-repayable contribution from the lender. It applies towards equity. You can't reduce your closing costs with something like that, but you pay for that in return. So usually it's a slightly higher interest rate.
Okay. And then the AMI?
Area median income. We use this a lot in commercial real estate. So you're looking at the average income for a particular neighborhood. So it's all categorized. I have tools that I use in CoStar and LoopNet and different products that we use to analyze a particular area. So when we're trying to figure out valuations. So is the average median income $140,000 in downtown, Gold Coast, or is it $40,000 or $50,000 in like Glenwood or Crete, Illinois?
Right.
So those make a big difference. And then if you're going to get a loan like this, I think you have to be at least 80% of the area median income. Is that right?
Yeah.
So if it's average income is $50,000, you have to have $40,000 income to qualify at least. So that's something you have to consider too.
Right. And then the PMI.
Yeah, again, insurance protecting the lender. Now, it could cost, just so you understand the costs here, and you can calculate this out, 0.3 to 1.5% of the loan amount annually, and it increases your monthly payment on top of the mortgage. So, obviously you want the 0.3 if you can negotiate it. Usually that doesn't work out that way, but something to consider, and that's a good benchmark figure to use. So I'd probably use 1%.
Right.
In the middle to figure out if you have PMI, this is it. And that's 1% is not a little bit. So
Right.
I was happy when I got rid of my 1%, I'll tell you that. It was
your
a good
PMI?
day. Yeah, when we got rid of our PMI, it was pretty quick. But you realize, it's $250 a month that you're no longer
Right. You don't
paying.
even
It's
look at
throwing
it. That's
away.
another thing. Look at your loan statement when you get it.
Yeah.
Your first one especially, and then you'll see all the
Well, no, do it before that.
No, but I'm saying once
Yeah.
you get it, and if you
Yeah.
have PMI, look at it,
Yeah.
and then kind of work with your loan officer. You don't have to do a one-time deal. Like, how can I get this down? How can I pay it quicker?
Well, usually the best way to get it down is to refinance, right?
Right.
So, yeah, or pay it down, but that's a big nut. The more realistic is if I bought a $400,000 house and in the past 3 years it went up to $450,000, refinance. And now you've gotten rid of
your
you put
PMI.
down $80,000, 20%, right?
Right.
Now you have another $50,000 on top of it. You're at $130,000, so you can get rid of your PMI.
Exactly.
Right.
So let's talk about the loan structure. Exactly. What does it entail?
Well, so the borrower contributes 1% of the total, and you get a 2% grant for the remaining amount. So the lender provides a 2% equity grant. Again, not usable for closing costs, just for the valuation of the property. So it's a total of 3%, meeting the conforming conventional guidelines for the value of the property, right?
Right.
And the loan valuation. Income, again, we just talked about it, but income limits typically 80% of or less of the AMI. Credit score has to be about 620, maybe 640. So it's a little bit of a range there. And PMI is going to be required, obviously, because you're at only 3% equity at that point.
Right. And, it may carry a slightly higher interest rate due to the grant, too. So,
Yeah, slightly.
Do you have any examples of people that have fudged their mortgages?
Yeah, I heard about this Department of Justice person in New York, Letitia something or other. And apparently she was prosecuting somebody for undervaluing their property. And it turns out she was doing this tricky thing with your mortgages where she's claiming different valuations and different usages. So, be very careful when you're doing this not to get caught up in these little tricks because it is federal crime, especially for a federal prosecutor.
So did she get pinched?
She's getting pinched currently. We'll see.
Oh.
Very, very exciting times.
Very exciting times in New York.
It's the kettle calling the pot black. Is that the scenario?
Yes. Does that remind you of when Pritzker took out the toilets?
Yes.
Exactly.
Oh, yes. The beautiful, the hypocrisy of being a billionaire. Yes. Does anybody know the story? Are you going to tell it or just leave everybody in the hook? The dude took out, he has one of the most beautiful properties in Chicago. There's 5 beautiful single families.
Single family.
They should be multifamilies. Right on Lakeshore Drive. And he bought one. A friend of mine owned the one next to his. Bought it and was rehabbing it, but he was getting taxed at the rates, which are very high in that area for that valuation. I think they're like $10 million a
yeah,
building.
It was like high, yeah.
And so to remove it from being taxed, he tore out all the bathrooms.
It was unusable.
Just as a gimmick to basically not be able to be taxed because it was no longer, quote unquote, usable in the tax parlance, apparently. So, these tricks, I don't know. At one level, if you're rehabbing it, maybe it makes sense. It wasn't a terrible thing to do, although he's a billionaire, probably.
He'll be known for the toilet gimmick for a long time.
But it is a strategy that people use. You tear out a kitchen, just FYI. If you're doing a rehab and you I'm going to rebuild my kitchen, people do this. Right. Literally, I've seen it happen. And they tear out the kitchen, then they're like, I don't know how to put it back together, or they get too busy and it's stuck. You cannot get a loan. If anybody wants to come in and buy your house, you can't get a loan. The banks will not loan the money on it.
Anything that's under
the toilet
rehab
scenario. Toilets are a little easier to put in than a kitchen, right?
Right.
But it really isn't that difficult, to tell you the truth. But nonetheless, you don't have a kitchen.
And you can't.
You have to put
I think
all
a lot of
cash offer
people think the as is okay if you tear out a kitchen and you say, I'm selling it as is. It is if you have a cash buyer. But if you do not have a cash buyer, they can't get a loan on it, something like that.
So, little tip.
Very little tip.
Learn from our governor. All right, let's talk about the different loan types and compare them out a little bit for everybody. And we're going to provide a chart for you to compare these loans. So there's basically 7 different type of loans that Stephanie's going to go through. Yeah,
we're going to put this on our website so you can pull it down, just so you have an idea. The loan, we've talked about this. We want to just bring it to your attention one more time. The conventional 1% loan is 1% down plus 2% lender equity grant. The FHA loan is a little tougher on a residential. It's a little tougher restrictions. Like we said, if there's anything wrong with the property or needs to be fixed, they're a little bit more stringent, I would say.
Yeah, but they're not. Their credit ratings are lower. They're more lenient on credit, but there is lifetime MIP, which is the federal version of PMI.
Right. And they're usually 3 to 5% down. If you are a veteran, which we love our veterans.
Yes, we do.
We have done something really nice for the veterans. We have done 0% down loans for the veterans, no PMI, only qualified people that you cannot be a daughter or son of a veteran. It has to be the veteran who applies for it. And
by the way, while we're talking about veterans, you hear there's a new project in Los Angeles that our new administration's about to work on. They're going to build a beautiful new facility for homeless veterans from the whole nation. It's like a huge piece of property. They're going to convert into housing for veterans. They're going to have no rent. And they're going to, I think it's like insane amount of people, like 30,000 people they're going to provide for.
Good.
So it's very exciting. So just so everybody knows, that's coming online hopefully in the next 18 to 24 months. And we want to take care of veterans because we're grateful to them.
And we want to make sure that hopefully that goes across the country.
And then we go into the farmers, who we also
love the
love.
farmers.
We love the farmers.
So we do have USDA loans, which is for pretty much farmers, I would say, right?
Yeah.
Yeah.
Yes.
It says rural areas, but I'm assuming it's just farmers.
Well, that's a good question. Not my expertise, but
Not mine either.
It's Department of Agriculture. It has
Right.
to be
So
for
they're
farms.
going to do, 0% down for you, low PMI. That's a whole nother scenario. We should probably bring someone in to talk about farms because
Yeah, if you're interested in this topic, again,
let us
all
know.
topics, let us know.
Yeah.
We'll dig into it for you.
and then we have the standard conventional loan, which most people is what they use for houses, when you're buying a house
3 to 5%
or a
down.
multifamily. 3-5.
I don't remember us doing 3 to 5% down, by the way. I guess that's the low end.
Right,
But we
of
always,
conventional.
we were
It's
always
usually
doing 20.
It is between 3 and 5.
What did Riley put down?
She put down 20%. So
She.
yes, with the help of her mother. But that was something that we decided based on all the fees and everything that worked for her. So
Yeah, but again, good point. Even though Moneybags over here could have put down full 20%, you don't want to do that necessarily because there might be benefits to only doing the 3 to 5. So leaving your daughter on the hook a little.
Huh?
Yeah, work for it, Riley. It's not being given away at the Stanley clan.
Right. Well,
or Weber clan.
Yeah, whatever. The PMI drops 20% equity. We'll leave that alone. Then there are the jumbo loans, which is 10 to 20% down, higher credit.
700 plus credit.
Yeah, and then the portfolio loans, which is more getting into multiple
Non-traditional borrowers. You're higher, very custom type of loan.
Right.
You're looking at multiple properties, things like that. So it's a different scenario. But
Right.
something to consider.
And then, just look at the 1%. If it makes sense for you, like right now, I think why I said to talk about this is because even though the rates might be higher, PMI might be higher, the rents are so ridiculous that
Yeah, it's true. You're
at
going
least
through
your
this right now, right? The
Yeah.
rent search for
my niece,
your
yeah.
lovely niece,
Yeah.
Brooke. We're looking forward to
Brooke.
having you back in Chicago, Brooke.
But it's not, people are offering $500-$600 over what they're asking for the rent.
Yeah. So, it's been a crazy time, as I said before about my situation with my tenants. I've been trying to hold it down here, but it's unusually high.
It's unusual.
Yeah.
I never saw my parents do that.
No, it's very different.
Okay, so let's talk about just some red flags, what to watch out for, false assumptions about the 1%
Yeah.
mortgage.
So, the 2% grant, again, just to reiterate, is not cash. You're not getting 2% cash.
Right.
It's coming off the valuation of the property, and you cannot use it for closing costs. Again, reiterate. It's going to come with a higher interest rate, almost 100% sure. PMI adds cost to the monthly payment. Some lenders do cap the loan amount too. So, you may fit all the other elements, but the lenders are like insurance companies. And the analogy is this. If the big insurance companies have a lot of houses insured in a hurricane zone, they can have oversaturation, and if a hurricane comes, they can go bankrupt or they'll be significantly harmed.
Right.
So they will cap how many insurance policies they're doing in a neighborhood. Same thing goes with financial institutions. They have to cap it. They have to keep, their exposure to a limited amount. So in some cases, they'll cap these loan amounts to maintain this across their portfolio.
Right. I think that's a big thing to look into. So if you're looking at a $500,000, $600,000 house or condo or whatever, like we just talked about the condo that was $700,000, this may not apply.
Well, it depends on the lending institution, really. So, one bank might be very tight, and another may be much less stringent and may have no caps at all. So it really depends on their exposure and their, what are they called? Not auditors, actuaries. We'll give them some guidance on how far they can go and when they should stop, or what cap they will have. So,
Um,
and then buyers have to be income limits, and they may need to have. This is a new one for both of us, I think.
Right.
They have to complete a learning program, an educational program on being a homeowner and how to manage your finances and things like that, which I love. I think
that's great.
In college, way back when I went, they had a class to teach us about, how to live in an apartment, rent, electricity.
Well, home ec, it should be coming
food.
back. I'm telling you.
No, it wasn't home ec. It was a finance program, and they taught us about 401k and the different finance options when you get a job. Here's what you should do. Here are the benefits. And it made me, hundreds and hundreds of thousands of dollars by following that information.
Right.
So almost $1 million by listening to that information. So it's good information.
Yep.
So taking a course like that, don't look down on it. It actually can be a real benefit.
I agree.
So always ask your lender, what is your interest rate without the 2% grant? Pro tip is what this is. So because it may not make a difference, right? If you're going to pay slightly less for a conventional mortgage than at a lower rate, just take it. You don't need the 2% grant. It sounds like free money. It isn't free. Nothing's free.
Nothing's free.
They're getting money somewhere along the line.
They're getting it back in interest rate.
It could be a benefit if you're really strapped. If you're really strapped, you really need to look at, in my opinion, do you really need to be a homeowner at this point, right? Do you want to put 1% down? Because you're going to be getting milked. It's like, what drives me nuts? When they have, in lower income neighborhoods, they have all these convenience stores and alcohol stores, right?
Right.
And so the people are going to these convenience stores and they're paying 20, 30% more for their snacks and their drinks and stuff, and they're never going to get ahead. But it's so much easier than getting in a car and driving to Aldi or Jewel or whatever it is. And this is the same situation. So
it is. I
just
totally
beware
agree.
of, what's the, wolves in sheep's clothing.
And I think also just looking at that, like you said, do you want to be a homeowner? But remember also, something to think about. If you get a 2-bedroom condo, and you could always get a renter in there and to help you. So there's all different scenarios, not just looking at your mortgage rate, but okay, I really want to live alone, but if I have a roommate for a couple years, I can do this and I can get ahead.
Yeah, true.
Yeah.
And that's what I'm advising Brett to do currently, and basically we're advising everyone to do. Save your money, invest wisely, live at home a little bit longer, and your parents usually don't mind, although it does get annoying sometimes.
John is still drunk from Florida, just so everyone knows. He's been back for a week and a half, and he's still drunk from Florida.
Not true.
He's. I don't know what he did down there with my brother that lives in the gray area.
Captain Caleb's fault, and Steve.
Captain
Steve also.
That brings his daughter to the bar. There you go.
It's like, I have nightmares of him with like a hook.
All right, let's give our
drinking rum, pulling it up the cork out of the bottle with his teeth. That's you, Caleb.
I know Captain Caleb, and I would have, that would be kind of, and people allow him to drive, and he does do a great job.
No, he's an amazing captain. I'll tell you, the guy does not mess around when he's captaining. It's almost, her brother is like a highly irresponsible individual, but when he's flying his plane, he flies as a pilot and a captain, although I will say he did a piss poor job of captaining this trip, which I'll tell you later. But when we're in a plane with him, he's very buttoned down. He's like dotting the I and crossing the T. He's going through all his pre-check. And Caleb's similar. He's very, very buttoned down. He's a real captain. It's why you sit there, I'm like, who is this guy I'm with at this point? He's like, woo! He's jumping in the casino like a lunatic. And the guy kills it in the casino, but he's just a raving gambling lunatic. But, you can't.
That's the life in Florida.
It is the Floridian life, I'm telling you. Those people are a little off the hook down there. It's like a perpetual
That's why
vacation.
John is still drunk many years later.
Yeah. That's why Stephanie fled.
Fled. 7 days I lasted.
She booked a condo for 2 months.
I couldn't stand it.
Left in 7 days.
No, I didn't. I stayed for a month.
Did you? Or a full month? Okay.
Yeah, the condo scenario was different.
7 days into the second month.
Yeah, when I bought the house. The condo was different because it was false advertising of how big it was. So the dogs and I literally were stepping over each other.
Stephanie and her 7 dogs.
Yeah.
One for every child.
Two
you
dogs.
Had 3.
I had 3.
Yeah.
Let's not talk about that.
All right. So back into the
Let's do the
scenario.
buyer scenario.
Yeah. So this is a scenario. Location doesn't matter. Income of the potential buyer, 75% of the AMI.
Right.
Average median income for the neighborhood. So if it's $100,000, they made $75,000 a year. Loan product, 1% down, plus the lender had a 2% grant added on.
Yeah.
So they don't have to really put down 1%. So again, close to the conventional, because conventional is 3 to 3.5%.
Right.
Seller concessions were involved. So this is where you can make some money back. Potentially. I mean, again, in Chicago, you're going to be competing in some of the big neighborhoods.
Yeah, you're
Miami,
not going to get this.
You're not going to get this. But in some of the other less competitive areas, you'll be able to get seller covering the closing costs or something like that for you to help you as well. Mm-hmm. If you have a good broker working on your side. And then surprise factor, monthly payment was higher than expected due to the PMI and slightly higher interest rates. So, when if you're using a traditional mortgage calculator and you're calculating this all out, and then you're like, 1%. If you don't recalculate that calculator and those calculations,
right,
you're going to end up, it's $700 a month more.
Right.
Or worse.
But in this case scenario, it was worth it. Yeah,
the buyer ran the numbers beforehand in the scenario and understood the trade-offs. And that's really what we're trying to promote here in the scenario. Scenario is to promote responsible borrowing behavior.
Right.
And we're talking about mortgages in this case and real estate, but we mean it everywhere. In your credit cards and any kind of financing, car leases, purchasing cars, same things apply. So
exactly.
Please consider that. So even when it sounds like it's free money, always model out your monthly payments because lenders don't take vibe as a payment. So your vibe doesn't come into the equation. And by the way, the worst scenario I ever had, I don't know if I got scammed. When I bought my Audi.
When you bought your what?
My car. So it was December 31st, and I was negotiating purchasing this car back in 2019. And I had to get it done for tax benefit. A huge tax benefit of buying this type of car. It's like 50% off.
So you're sitting there on December 31st.
December 31st, I was squeezing the guy, and he's like, well, I guess we can't do a deal. I'm like, oh, no, wait. No. So I was pushing him as far as I could, and then he started walking. I'm like, I'll reconsider. And then I went through the finance guy, and oh, my God, I got shredded. They are crafty.
They are very crafty.
You're going to be protected. You should use this. I don't even know. We should do an episode on car loans.
We should.
Because it was daunting. They are whisking things by. You're like, what? Wait, how much? What? 2,000 flat tires? What? How much are tires? Yeah, it's lots of nuances I could tell you on that road I went down. But anyway, plan it out. Lay out your own calculator. What were we talking about? We looked at this. Loan estimator. Do a loan, get a loan estimation calculator. Before you go in, to do these financing, to engage in purchasing this thing, you want a loan estimate from your bank.
Right.
You want to get that up front, not the closing disclosure, which is 3 days before, because then the heat's on. Right. And you're
then
like, it's like walking away from a marriage, right?
Yeah.
We're about to get married 3 days. Do I really love her? You don't want to be that guy, right? So,
right.
Or woman. So you really want to do these math calculations way in advance. You don't want to waste. Listen, we don't want you showing up, not knowing what the hell's going on. And I'm working with the guy now, and he keeps trying to get into these buildings. I'm like, you do not qualify. Okay? And one of our friends did this to me. I'm like, I'm not going to the building. You cannot buy the building. I don't know how much clearer I can be to you. So they're like, oh, we just like to go look at this building.
Qualify.
You can't buy
It's not like
the
show and
property.
tell. And when you work at the broker, please remember that too.
Yeah, don't drag us
Don't
into
drag
these
us everywhere
useless
to useless stuff.
Yeah,
And
we're
then,
not your chauffeurs, and
Right.
it's commercial's different. It's why I wouldn't go into residential.
well, in residential too. If you're
residential
not,
especially.
if I'm telling you that the price you're seeing and it's going to go for $20,000 or $30,000 over what is being listed, don't get mad at me. First of all, I didn't write the scenario. I think it's stupid. But also, if you're not prepared to get in the game, like it's a game now. Like you have to get in. If you don't want to
and
get
you
in,
better
the game,
have a buffer up,
Yeah.
right? So
Buffer up.
And what I'm trying to get at is, don't be asking to go look at a $700,000 home or condo, and you're approved for $500,000 because
where are you going to get the $200,000?
or even $690,000. Okay. Don't look at a $700,000 condo if you don't have $750,000 approval.
Right.
Okay. Because it's wasting everybody's time, including yours. And
Then you'll be upset that you can't go to this house and you'll never get in it. And then you'll be like,
and after the geniuses in the Chicago mayor's office who put in bike lanes everywhere, so it takes a half hour to drive any place. You do not want to waste anybody's time because brokers are likely to snap on you in the car. You don't know. Could happen.
Is this from past experience?
I don't know. It just, could happen.
Could happen.
Don't push us.
Oh my God.
All right. So now we'll get into some kind of Q&A. We're running a little long here. Do you want to go into this? I think it's good stuff.
I'll let you just read through it. Yeah, read through it.
All right. Does 1% mortgage make me more competitive in bidding war? No, it won't. Mm-mm. So look, you're competing, right? So you need better numbers behind you,
right?
Not worse. And, it's just going to make it a little bit harder. So understand that in a competitive market, that's another thing you have to consider. Do I want to do this 1% loan?
Right.
Because you're going to go through 10 locations where you lose it because people are offering cash everywhere.
Right.
Or they're more competitive loans and they'll be willing to pay higher maybe. Can this loan be combined with other down payment assistance? Yes, often. Mm-hmm. But I work on layered financing projects. It's a great way to leverage money and leverage programs to buy great commercial properties. Not so great for residential. It gets complicated. So,
there's first-time homebuyer programs that can help.
Yeah, and there are options out there, but they have restrictions and caps. So just so I'd use a spreadsheet because I'm a spreadsheet guy.
We know.
You got to put all those caps out there and, build it strategically and logically, and you'll be able to figure out whether it makes sense or not. How long do I need to stay in a home to make this, for this to make sense? With all the fees and the PMI and all the stuff added on to this particular loan type, I'd say 3 to 5 years.
Yeah.
It's probably going to be reasonable.
I agree.
And you have to consider that if you leave early, could it erase your equity gains?
Yeah.
So if the market's just getting hot and you're going to leave and you're going to leave a lot of money on the table, that's a consideration. And is it worth paying points to buy down the rate? Well, it depends on how long you plan to stay. I'd say that definitely makes sense if you're going to be in a location more than 5 years.
Right.
Then it could pay off, but you have to do the calculations yourself, use a calculator. So these are, these programs are tools. They're not miracles. They can be leveraged when appropriate, and it can make sense. You have to look at the economy, the market, your circumstances, personally and professionally, what's going on.
And the fine print.
And, of course, the fine print and all these things. And
right.
Make sure that you're looking at it wisely. Make your own calculations. Get the closing disclosure 3 days before the closing, of course. But, again, do the loan estimate way before that. And do a shadow closing disclosure. Do it on your own. You could find documentation. You could probably have ChatGPT write one up for you.
Right.
So make sure you do that and use a closing cost estimator calculator as well. And that'll put you in a good situation to know if you're in a good situation or not.
Exactly. And just in conclusion, the 1% mortgage is legit. Not always the best deal, but you kind of have to look through that, compare it with the FHA, VA, USDA, standard conventional options.
Yeah, whatever applies to your situation.
Whatever applies in a high rate market. PMI interest rates can be drastically affect your total cost. So just be sure to ask all the questions, ask all the scenarios of your loan officer to make sure you're getting the best scenario for you.
Yeah.
We'll put this up on the website, the residential loan comparison chart, and also the 5 smart questions to ask. And then what's coming up next?
We're going to focus on how to buy a duplex. So live in one unit and have your neighbor pay your mortgage. Yes, you can be a landlord and without turning into a bad guy. I mean, that's what I'm trying to do.
Are you a bad guy, though?
No, I'm not. I've raised rent in 2 years. I'm a wonderful guy. But, it's easier than you think.
Yeah.
Although there's caveats, right? When I bought my building, I gutted everything, rebuilt it. So I have brand new electrical, HVAC, plumbing, insulation, everything. I like to do it that way if you're going to do multifamily, but
in this market, that might not be possible.
It
but
might
you
not.
can.
I mean, that was 1998. I was so happy I did that.
Yeah.
Oh my gosh! But anyway, there's ways to do it. We'll talk to you about that, and we'll give you some more tips. So thank you so much.
Hope you
enjoyed
so much.
the scenarios and the segments, and we love your feedback. So please give us some feedback
and let us
thumbs
know
up.
any topics that we're
And
missing.
subscribe
to the showmehowpodcast.com.
That's right. And look out for our dogs and our family.
If mine's running down the street,
what
please
are they called?
snag her. Her name's Misha.
No, what are the things we're
just
doing?
call
The
me.
social media clips. What are they called?
Oh, Furry Friday.
Furry Friday. And
Grizzly will be fighting with people in the park.
Usually dominating. That's what I'll be doing.
Bye, you guys. We'll see you next time.
Bye. Take care.